we have just talked about what are the differences between the temporal method and the current rate method. Now let's look more in detail about the current rate method. So as you may recall, under the current rate method, all of the assets and liabilities are translated at the current rate. And then on the income statement, we talked about we use the average rate, but the specific, to be more precise, actually, all of the revenues and expenses are translated at the exchange rate in effect at the date of accounting recognition. So the reason for revenues and expense, we use the average rates. That is because we're actually making an assumption here, which is revenues and expenses has been recognized evenly throughout the year. So there's actually an assumption here for us to use the weighted average exchange rate. And however, so if an income account such as gain or loss occur at a specific point in time, and you can identify that point in time, actually under that situation, the exchange rate as of that date is applied. So we use the historic rate at that time. Depreciation amortization expense translated at the average rate because those expenses occur evenly throughout the year. So we talked about we use the average rate, but here, just to be more precise, if we can identify when gain or loss occur, we need to use the rate at that point in time. So now let's go into a more specific example. And then the example is here, but it's just a translation example. So if you go on Island, you're going to see some blank handouts. So one blank handout for the current rate method, another for the temporal method. Please first download that handout for the current rate method, because here the assumption is US francs is the functional currency. So I'm just going to briefly tell you the setting here. The parent firm is a US firm, so it uses US dollar, and the subsidiary is a Swiss firm. Which operates in Switzerland, so it is using Swiss franc. So and then the functional currency is Swiss franc, which is equal to the local currency. So this is the reporting currency. And then so if you still recall, from the local currency to the functional currency, we use the temporal method. From the functional currency to the reporting currency, we use the current rate method. And in this situation, because the local currency is the functional currency, so this step, we don't need it. We only need the current rate method. So that's why we use the current rate method here. And all of the rest is just to do the translation. So let's look at the handout. So this is the blank handout. You can download it from your island. Basically, we already have the firm's 3 major financial statements here, and what we need to do is to decide which rate to apply, and then we just do the translation. If the firm is using the current rate method, we start from the income statement. So on the income statement, because none of those items, we can identify it to any specific date, so we just use the average rate to all of those. And the average rate is 0.65. This you can find it from the example. So then we just do the translation. For example, for sales, that's 4 million multiplied by 0.65. That gives us 2.6 million. So I'm just going to write it out here, but it's just you just multiply 2 numbers. So this is income before income tax. You just add up all of the previous numbers. So nothing needs to, as well as gross profit. So gross profit is sales minus cost of goods sold. So there's no exchange rate needed here. So same as here. And then income tax is 130,000. So you just so income, we use income before income tax minus income tax. That will give you net income of 305.5 thousand. And this number is carried over to your statement of retained earning. On your, oh sorry, carried over to here. Beginning retained earning is 0, and dividend, because dividend is part of return, is part of the shareholders' equity. So we use the historic rate, which is 0.67. And then retained earning, you just add up those numbers. So, and then this retained earning is carried over to your balance sheet. On your balance sheet, all of the assets and liability, we use the current rate. And shareholders' equity, we use the historic rate. So the translation rate, the current rate is 0.7. Historic rate is 0.6. So maybe I should go back to just to tell you where those rates are coming from. As you can see here, the average rate is 0.65. So that is the average during the year 2015. And then the historic rate for the dividend is 0.67. So rate when dividend was declared, that is this rate. Current rate 0.7. So that is the rate at the end of the year. And the historic rate of the common stock and the additional paid-in capital, that is when the firm was, those common stock was first issued, which is 0.6. So those are where those rates coming from. So let's come back to, and then we just do the multiply the two numbers again. And then if you add up everything, that will give you your total current asset. You add up everything again, that will give you your total asset. Total liability, that's the, you just add up everything. Common stock, 60,000. And then one thing is here. So your total liability and equity should be equal to your total asset. So you may notice there's a new account here, cumulative translation adjustment. And the way we get this number, it's not calculated. Well, it is kind of calculated, but it is not, we use something to multiply something. This is viewed as something to balance this balance sheet. So whatever amount we put in here in order to balance this balance sheet, we will put it here in order for it to balance. So the way we are doing it, in order for it to balance, your total asset should be equal to your total liability and equity. So which means that your total liability and equity should be equal to 1.169 million. Which means that your total equity should be 574,000. And then in order for your total equity to be 574,000, your cumulative translation adjustment needs to be 69,000. So this is how we calculate this number. There's no multiply or anything we can apply to it, because on the original, the foreign subsidiaries original financial statement, there's no, this account doesn't exist. So this account only comes out after the translation. That's why there's nothing we can use to multiply or anything. This is basically an account we're putting there in order for your balance sheet to balance. And can you understand why your balance sheet would not balance after the translation? Just a very quick note. So without this account, your balance sheet is not going to be balanced, because as you can see here, your original financial statement for the foreign subsidiary, it is balanced under the foreign subsidiary's local currency, right? And then when we do the translation, we are applying different rates to different items. So of course, after translation, this balance sheet is not going to balance. If we have using the current rate for all of the income statement items, it will balance. But because we're not doing that, so it's not going to balance. It is not going to balance. And in order for it to balance, we need to add a new account, which is only for the statement after translation. So that is the balance sheet. And then let's look at the cash flow statement. The cash flow statement, net income is kind of carried over from your income statement, which is 305.5. And because we have used the average rate for all of the items on our income statement, so it is the same as we just apply the average rate to your net income under the local currency. And then all of the other operating activity, we just use the same rate as what we use in our income statement, which is the average rate. So, and then we have 65,000. And then if you add everything up, that will give you 474.5 thousand. Investing activity. So for the investing activity and financing activity, we use the historic rate. Which is 0.71, 0.61, 0.62, 0.61, 0.67. And just for you to know where those rates coming from. So the first one, purchase of PP&E, that is this rate, 0.61. Acquisition of patent, we use this rate, 0.62. Long-term debt, so long-term debt, also 0.61. Payment of dividend, 0.67. So those are where those rates coming from. And then if you add up those, that will give you 641,000. If you add up those, that will give you 52,000. So if you add up these three numbers, that will give you your total increase or decrease in cash, which would be 114.5 thousand. And then on your cash flow statement, we have cash at the beginning of the year, which is basically which we apply the historic rate, which is the current rate at the end of 2014. And here it's just like if we're standing at 2015, that is the historic rate, which is 0.6. So let's check that rate again. So yeah, this is the rate at the end of 2014. Because for cash, we use the current rate, but that is the current rate at the time at 2014. So that is 0.6. And then cash at the end of 2015. So that is from the standpoint of 2015, that is our current rate. So which is 0.7. And then your cash flow statement is not going to be balanced now. So in order for it to balance, whatever just for it to balance, we put it into a new account called effect of exchange rate change on cash. So as you can calculate here that it would be negative 4.5 thousand. So this is the current rate method.